Hi, happy Friday, and welcome back to Financial Wellness Fridays. I hope you all had an amazing week and are as excited as I am to be back this week. I'm super excited for this week's episode because we're going to be talking about investment, which not only is a super hot topic among young adults today, but is also a super important factor in preparing for your future, which is basically what we're trying to accomplish with this channel and getting young adults to be financially well now and in their future so that they are able to be successful. So if you want to get started with investment but aren't sure how, or if you just want to learn a little bit more about different types of investments, then go ahead and stick around for this series. So today I want to kind of introduce why investment is important and then go over one option that I think is super great. So investment is important because of something called inflation. I'm sure you've heard this term thrown around a lot over the past few years because inflation is at a super high percentage right now because of the pandemic and the economy just not doing super well. So that essentially means that your dollar that you had a couple of years ago is now worth less than it was those few years ago. Essentially, inflation is the increase in prices of goods and services in a certain market. And when the price increases of a good or service, that means that your buying power of your dollar also decreases. So essentially, if you don't invest and you aren't earning money on the money that you already have, you're actually losing money. The best way I can explain this is if you have $1 today and you can buy a candy bar today, but you choose to save that dollar, but not in any account that earns interest or anything like that. You just put the dollar in your checking account and you just leave it there. In a year, when inflation increases, let's say 3%, now the candy bar, instead of costing $1, costs $1.03, and your dollar can no longer purchase that candy bar because it wasn't keeping up with inflation. So now you've essentially lost your buying power of 3 cents. That's why investment is super important, so that you aren't losing money on the money that you already have. Now, I know right now that investment is super scary because the stock market is all over the place. One investment strategy that I think is super cool is a Series I savings bond. Savings bonds are essentially a loan that you give to the government. So you're acting as the creditor, and the government promises to pay you back that amount plus interest on it, just like a normal loan that you would get from a bank. Series I savings bonds are especially cool because the interest rate is adjusted for inflation. So if inflation is high, the interest that you're going to be earning on that loan that you gave to the government is also going to be high. For example, inflation is at an all-time high in the last couple of years, so the savings bonds are at a 7.12% interest rate. And that is compounded semi-annually, which means that you're going to be earning compounded interest on that loan that you give to the government, which is super awesome. So you can buy a Series I savings bond at the 7.12% through the end of April, which I know is coming up, but they're going to be adjusting the interest rate at the end of April because they do it at the end of April and at the end of November. So again, it's adjusted semi-annually for inflation. So if inflation keeps going up, so will your interest rate. So that's why Series I bonds are super cool because you're going to be protected from the inflation of the economy. Now, there are a few caveats to savings bonds in general that you need to understand. They're a lot like savings certificates where once you put the money in, it's not really liquid anymore. You can't get it out whenever you want to. Series I savings bonds are a lot more flexible than other savings bonds where you only have to keep the money in for 12 months. And then after that, you can take the money out at no penalty. However, if you take it out before 5 years, you will lose the last 3 months of interest. So that's okay. You can take it out and lose a little bit of interest if you need it in an emergency. That's totally fine. But if you can wait past that 5 years, then you can cash it in at any time and claim that interest. Series I savings bonds continue to make interest for up to 30 years. So after you've had it for 30 years, it's a great time to cash it in. I think Series I savings bonds are especially great for saving for things like retirement when you're young, or even buying a home because you can cash it in 5 to 10 years and then, you'll have a little bit more money rather than putting it in a savings account that isn't making as much. So I think Series I savings bonds are super cool, and the great thing about it is that you can invest without worrying about losing any of your money in the stock market. So it's a great way to dip your toes into investing if you're still a little bit nervous to jump right in. If you have any questions, leave them down below, and I'll also leave the link down below to purchase Series I savings bonds if you want to. Again, you have through the end of April to purchase it at the current rate, and then we'll see in a couple of days or weeks what the new rate will be and see if we want to purchase more. So I hope you enjoyed watching today's video. As always, comment down below if you have any questions. I would be happy to answer them for you. Of course, like the video if you enjoyed learning about Series I bonds with me today, and hit the subscribe button and the notification bell so you don't miss our upload next Friday. Have a wonderful day, and again, happy Friday.